Larry, again, we talked about the investment banks. Clearly, that's changed, and Michael brought to the point that Raymond James is now is a big player in the marketplace. What happened? How did we get here?
Thank you. Just think, it was just 2 weeks and 1 day that passed that Lehman Brothers filed for Chapter 11 protection. It's hard to imagine. I mean, it seems like it's been 6 months ago. So much has happened since then. So what I've done here is I've put together a list of everything that's happened over the last 3 weeks. I'm going to go down through that, explain what all happened, and then talk for just a minute about what the current status of these companies are, and just make a couple other comments. Late in the day on Sunday, September 7th, which is the first item up there, Treasury Secretary Paulson announced that Fannie Mae and Freddie Mac will be placed into a conservatorship under the Federal Housing and Finance Administration. During the rest of the week, attention focused on Lehman Brothers' attempts and failure to recapitalize and Washington Mutual's weak capital position. By Friday, September 11th, it's reported that Bank of America was in talks to buy Lehman Brothers. That weekend, things really picked up. On Sunday, Merrill Lynch announced that it was going to be sold to Bank of America. Apparently, Bank of America said no to Lehman Brothers and bought Merrill Lynch instead. The following day, Lehman Brothers announced it will file for Chapter 11 protection. Within hours of the Chapter 11 announcement, Lehman sells the bulk of its security business to Barclays and Nomura. The Dow Jones dropped 504 points on that day. The next day, September 16th, Paulson and Bernanke announced a rescue plan for American International Group, one of the world's largest insurers. The Treasury will lend $85 billion and will receive warrants on stock that will give the government up to 80% of the stock when exercised. The government essentially became one of the largest insurers in the world. Late on Tuesday, it was announced that Lehman bankruptcy caused 3 money funds run by the Reserve to break the buck. The largest $65 billion primary fund's net asset value is reported to be 97 cents. On Wednesday, September 17th, a run on the primary fund by institutional investors caused the fund's assets to drop from $65 billion to $27 billion in 1 day. Eventually, it fell to under $7 billion. On Thursday, September 18th, the run on the money fund expands. Putnam imposes a 7-day cooling-off period on 17 funds that it runs. Total money assets drop $169 billion from the week before. Facing a run in the money market funds, the Treasury promises to reimburse any fund that breaks the buck. This guarantee stops the run on the money market funds. However, all of the money pulled out of the money funds were dropped into the T-bill market, and T-bill prices rose to where the shortest T-bills were paying 0 interest. This is the first time this has happened since the Great Depression. September 19th and 20th, this is the weekend before last, sees news reports of a bailout plan to try and get ahead of the crisis. Instead of reacting to each day's catastrophe, the Treasury Department wanted the financial markets to know that the Treasury was willing to do what was needed to shore up the system. September 21st, Morgan Stanley and Goldman Sachs announced approval of conversion to commercial bank holding companies. September 26th, Washington Mutual fails. Bank is seized by FDIC and assets are sold to J.P. Morgan Chase, the largest bank failure in U.S. history. September 28th, last Sunday, Congress and Treasury agree on a revised rescue plan that will be submitted to Congress and debated on Monday and Tuesday. September 29th, yesterday, Wachovia Bank, after failing to recapitalize, is sold to Citigroup. The House of Representatives rejected the rescue plan. The stock market dropped 777 points, the largest drop in absolute dollar value, or absolute value for the Dow Jones Index, largest of all time. Not in relative terms, but in absolute. So, what is the status of Wall Street investment banking? Here's the list of the 5 largest Wall Street investment banks. As you can see, remarkably, they're all gone. The first was Bear Stearns, which was forced to sell itself to J.P. Morgan Chase. Lehman Brothers is gone, went bankrupt. Merrill Lynch was bought by Bank of America Corporation. Morgan Stanley, Goldman Sachs are now commercial bank holding companies. It's an amazing picture, and just all unraveled, mostly unraveled over the last couple of weeks. One of the most contentious issues facing Congress and the Treasury Department is trying to fashion a response to the crisis is what type of oversight and regulations needed in the financial markets. Since the late 1970s, the U.S. has, over time, adopted an economic philosophy that regulation, for the most part, is more costly than beneficial. Building on the success of deregulation in airlines, natural gas, and interstate commerce, there was a wave of deregulation across the spectrum of financial industries. This had a profound influence on commercial banking, mortgage banking, investment banking, and in the securities industry. On the other hand, there's been a consensus building over the last few months that deregulation has gone too far and is at least partially responsible for allowing the excesses that led to the current crisis. The current activities of the Treasury, the Federal Reserve, and the Congress seem to be almost a whipsawing of the philosophy of deregulation. There currently is a rush towards imposing government intrusions on the market that would have been frightening just a few months ago. I would like to point out that, curiously, the financial markets are adjusting to the crisis by imposing its own operating constraints on the participants. Lehman Brothers is gone. All of the rest of the investment banking companies, the real large ones, the bulge bracket investment companies, have either sold themselves to commercial banks or converted to commercial banks. It was clear that the capital market no longer trusted these companies to operate in the unregulated arena. They couldn't raise the capital, and they had to change. It's almost as if the government wasn't doing its job of reasonable and helpful regulation, and so the market stepped in to provide it. It may be that the markets, believe it or not, are stronger now because of these adjustments over the last couple of weeks. I hope that's the case. Finally, I would also like to point out that right now as we speak, every financial institution in the world is struggling to deal with the issue of lack of transparency and trust. 2 months ago, they were surprised by the true value of many of the assets in their portfolio. Now everyone is carefully examining their own portfolio and trying to design strategies to reduce their exposure and risk. They're also carefully looking at the risk exposures of the companies they do business with. This clearly can ultimately reduce the overall risk of each company and thereby reduce the overall risk of the market. In re-examining their risk exposure, the financial companies do not like what they're finding. However, because of this increased attention, everybody's making decisions that are better informed than they were just a few weeks and months ago. The actions of each individual institution to fix its own portfolio and to limit its exposure to counterparty risk will ultimately make the overall market more stable. Surely there remains substantial risk in the credit markets, in the stock market, and in the economy. I anticipate that volatility in the stock market will continue. However, I predict that if uncertainty continues in these markets, we'll adjust to them and we'll figure out how to design the necessary financial institutions. And that's what happened.
Thanks, Larry.